Well, good afternoon, everybody. Welcome to our Short Verticals webcast. I'm Connie Hill. Happy you would join me here today as we discuss short verticals. Question came in from the survey, and it actually was more of a request that we're going to really focus on here today. And the focus was, how do I get my reward risk ratio to a point where I'm comfortable? Okay, so some of you might really be comfortable with where you like to target your risk reward ratios. And some of you might be floundering a little bit. So we're going to put a little bit of extra emphasis on that here today. Now, we've got Barb Armstrong in the chat. You guys are so happy to see Barb back, aren't you? So am I. We're happy that her surgery went well and she's coming along in her recovery. She will help me answer questions that maybe I can't quite get to, maybe a little bit off topic. So I'm glad that Barb's there, a great veteran of the markets and good friend. Now, as you have those questions, type them in. And if you're in the archive listening to this and you have questions, put your questions in the comment section in the YouTube video, because I go back and look at those throughout the week, make sure you get your questions answered really quickly as well. Now, I hope you're following us on X. I'm Connie Hill CS. Barb is Barb Armstrong CS. Post educational content out in our X account. It's free to follow, and you can pick up some little nuggets on the way. Let's go through our disclosures and get through our agenda here. Options carry a high level of risk and are not suitable for all investors. What we talk about here today is for general and informational purposes only. Don't consider it a recommendation. The paper money software application is what we're going to be using. That's what you download to your computer. It's a very robust version of Thinkorswim. Investing involves risk, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An in-the-money option has a higher risk of being assigned early. One thing that paper money does not mimic very well is that early assignment. It won't assign you early, but a market will assign you early, so you want to just be aware of that. And I try to point some of those circumstances out when I think, hey, maybe in a live market situation, we may have been assigned a stock or something of that nature. Past performance of any security or strategy does not guarantee future results or success. Now, I want to give you a little nudge to head on over to one of our market drive events or our workshop. Next two market drives coming up that still have availability would be Dallas, September 20th. So you got a month to make up your mind, okay? And then Chicago, October 4th. And then a workshop, which will be 2 days, October 10th and 11th. First day is technical analysis. The second day is options strategies. You don't have to register for both events, but both are available to you. And a lot of people like to do those back to back. So if you can fit it in your schedule or get your body over there, you will be thanking me later on. In fact, you might send me flowers or something because you are so happy about that. All right. Now, our agenda, typically we talk a little bit about some element of short verticals, and I've kind of hinted at that already about identifying proper reward risk ratios that you feel comfortable with. Okay, so we're going to be looking at some examples here today. We have a couple of trades to follow up on. Actually, some of our trades have come to fruition, and we've just actually got only a couple of things in the hopper right now for us to discuss. So I'm going to pose this question to you now that we probably have more folks in here than we did at the beginning is, are you comfortable with your reward risk ratio and knowing, what you want to target when you're putting together a short vertical? Okay. If you want to respond to that, I'd be happy to see what those answers might be. I'll keep an eye here on the chat, just see if somebody actually commented on that. Probably maybe not yet, but go ahead and answer that. We're going to hop over to Thinkorswim. And there's our Thinkorswim. I've got the SPX chart up here. And we have on the chart our blue 10-period moving average, our red 30-period moving average, and something that I added on today, this lovely mint green, is a 50-period moving average. To just give us an idea, okay, the market's pulled back a little bit. How severe is this pullback? Okay. Honestly, we would need to have a lower low, a low lower than the low on this candlestick here. to even start to be thinking about a reversal of trend. It's down to the 30, which is kind of the short time end of that intermediate moving average. It's not even close to the 50. So overall, you look at those things and you go, well, we're still in an uptrend. We're just in a little bit of a pullback right now. Okay, let's look at the NASDAQ. Get that out of the way. On the NASDAQ, same thing, although it pulled back a little bit more. It got closer to this 50-day moving average over the last couple of days, and we have seen more selling off in the NASDAQ than we have the SPX. But same thing here, did it come down and form a lower low? Sure hasn't. It would have to, at this point, it would have to go below the 50 moving average to get close to that most recent low. Okay, so same thing, it still is in an uptrend. And let's see, looks like we're down 0.5% on the NASDAQ. We're down a little bit on the SPX. Our volatility index, we'd expect it to have popped a little bit. Let's see how much it has. Looks like it's up to 1666. And, that's really in a range that maybe we might start to become concerned if it, maybe gets up to 19, 20, 21. Then we're probably noticing some major changes in the marketplace. But, a low here is about, what is that, 14.3. And so it's really not that far above it at 16.68. Okay, so yeah, volatility's increased a little bit, but not so bad. Now I'm going to check in the comments here and see what you said as far as if you're getting comfortable defining your reward risk ratios. Lakshmi says risk reward ratio is an advanced level question for me. I like the theme of the session. Okay, Lakshmi, maybe you were the person that answered the survey last week and said, can we spend a little bit of time on this? And my initial thought was, well, we talk about it every week, but I thought maybe I don't slow down enough when we review trades each week. And so we're really going to dig deep into that. Okay. Chris is going to the Dallas event. Awesome, Chris. We will be so happy to see you there in Dallas. John's getting kind of sort of comfortable maybe with the reward risk ratio and how you might do that and decide your own. Very good. I appreciate you letting me know kind of where you stand on this. So let's do this. There's one slide we're just going to go visit here real quickly. And then we're going to spend the rest of the time out on our Thinkorswim platform. And these are just things that you might want to consider about. This is specifically short call verticals, but it's similar with short put verticals, right, that are bullish. A short call vertical is bearish. And, we'll look through these considerations here because we're going to go into a little bit more depth on them, okay? But generally, we're going to look for a delta between 30 and 40 for the leg that we're going to sell. Do we have to be between 30 and 40? We don't have to be, okay? That just might be an area to target that some people like. This one, the long strike, buy a call strike price above the short strike price, and it results in a credit, okay? Return on risk gets into our topic here about reward and risk. You may have a minimum return requirement that you want to have. Now, many people, and hopefully this will be you at some point, get comfortable with this idea that we're working with a teeter-totter. Okay, we're going out to the playground. Here's our teeter-totter. And on this side, we could have, say, the reward. That's an RE. And down here might be, we're balancing risk and reward here, okay? The higher our reward is, actually, probably the higher our risk is. The lower our risk is, probably the lower our reward or our return on our reward is likely to be. And so we're just kind of trying to find the right balance of where you're comfortable. And it can be different for you than it might be for me, or that it might be for John or Riceberg or anybody else, right? you've got to be able to sleep at night. And so we'll talk about what is your sleep at night area where you're comfortable with. Okay. So the first stock we're going to look at is going to be a bearish stock. Let's jump back to our Thinkorswim. We're going to pull up here. Let's go with IBM. All right. Most of you know, if you've been here at our class, and we work with a watch list that we say all our trades are going to come off of. This is the watch list. It's right now currently called Short Verticals Class 7/24/25 because that was the last date we updated our watch list here. And we are going to be using this watch list for both bullish and bearish opportunities. And so every trade that we look at here today, that's going to be the case. Our first one here is IBM. So what do we have going on with IBM? We have basically all the moving averages are heading down, including that 50. It's below all of them. And, you know, it's had this little tumbling game going on here. Just recently, what did it do? Ran right up to the 10 again. What's it doing today? Looks like it's bouncing down below it. And so we also might look at that and say, oh, you know, the market's not closed yet, but if we were to close right now, we would have a close below the low of the high day, which a lot of people like to use as an entry signal for something bearish. Okay, so some people will say, well, if it's already doing that, it's trading there, even though it hasn't closed yet, they might take that as a signal. And that's what we're going to do on this. Yeah, market's not closed yet, but if it were, definitely the price right now is lower than the low shadow here, which was 240.34. We're just a little bit below that. Okay, now we're going to head over to the trade page. For our example trades today, we're going to be using these September 19 options. And, you know, maybe 30 is a little overkill right now. Let's maybe just say go with 20. And if we're bearish on something, we're going to do a short call vertical with this idea that we're going to sell a strike price, but we're going to put a hedge on it because we don't want to have unlimited risk out there. And by doing that, buying that hedge leg, that's what it allows us to do. Now, in our slides we saw, you look for between a 30 to 40 delta, generally speaking. And so here, if we're looking at possibilities, we've got a 33 and a 39. If we go a little bit higher into the 40s, it's up there at 45. If we go down a little bit lower, it's at 27. Now, there may be some of you that are completely comfortable with all four of those. That could be the case, but then you might want to just kind of zone in on your preference. First one we're going to take a look at here. We're going to start out with our 250 strike price. That's the 27 delta. That is a little bit lower than that range. And we're just going to go ahead here and say sell vertical. And I'm going to come over here and I'm going to make our math a little easy here. We're going to go up a penny. We're going to lock that in so it doesn't wiggle around on us. So here on this teeter-totter, the reward here is 60 cents of a credit. And what's the probability that this trade could work out in favor, expiring out of the money? Well, right now it's sitting at about 74%. Now that's kind of nice and comfortable. Okay, your probabilities are higher. And so some people might feel comfortable with that. And then the next question is, well, is it going to give us enough of a reward? Okay, so we're going to crunch some numbers here. Today is a numbers crunching session, you guys. So here we know our max gain is 60 cents. Let's give some separation there. So our max loss on a $2.50 wide spread, our max loss should be $1.90. Okay, so we're willing to risk $1.90 to make 60 because we have a 74% probability of that trade working out in our favor. Percentage-wise, we want to calculate that return. And actually, I'm going to use a different calculator here today and see if this works out a little better for us. Okay, so we're going to take our 60 cents. We're going to divide that by our $1.90. And that's going to give us a percent return. Now, this one's actually 31%. That's a little higher than I thought it might be. It's a little bit higher than it was earlier today, but I'm going to go ahead. I'm going to plug that in there, 31%. And so some of you might initially say, I'm not so sure if I'm comfortable with that or what. It is a little bit different than the norms that we look for because we did that 27 delta. If that is something you feel good about, you're like, oh yeah, I can sleep at night. If I lose $1.90 on this trade, because it equates to 190 per contract, if you can feel comfortable with that, that's great. Now, if we came out here, and let's say we just went a couple of strikes down, say we went at this 18 delta, okay? I've got a blast all here so we can line up some orders to compare. Typically, you're not going to want to have multiple orders that you're going to trade, all right? But you do want to compare, okay? So that's what we're doing here. We're going to go with the 18 delta, which is the 255 strike. You'll notice all of these have pretty sufficient open interest and volume. I've got those open there. Okay, now this one is kind of almost the opposite. Oops, what happened to our first guy? Our first guy, let's get rid of this. Did I click over it? Okay, let's get this one in. All right, well, that's that one. Let me go bring this guy back. The 250 fell vertical. Maybe that's what I did is I accidentally clicked on the blast all and it changed it and I didn't notice when it did it. So we're going to set this up one more time here. And that's changed a little bit. It was 60 cents. I kind of liked it at 60 cents for illustrative purposes. Otherwise, they're a little bit close together. And this one looks like it's about 49 cents. So in this case, we're saying we would be content with 49. This is not right here, though. Let's try this one more time here. 250 is where we were starting at. There we go. Okay. That's the very first order, and it was about 60 cents. Okay. The second one, we're going with the lower delta. Okay, we're going with this 18 delta here. And we're going to say sell vertical. Okay. That is more what I was expecting here. I'm going to go ahead and lock that. In this case, our gain would be $35 a contract, but how much are we risking? Okay, we are risking here, grab our calculator back up, 250 minus 35 should be what, $1.85? Is that right? 2.5 minus, or 0.35. So yeah, $1.65 here. So that's going to be our max gain. Our max loss potential is going to be, what was that, 135? What kind of a percent is that? Let's see. Actually, this is 165, not 135, 165. So if we grab that percent, we may say, okay, 0.35 divided by 1.65 is 21%. So some of you might go, well, that's kind of puny. I don't even know if that's worth my time. Yeah, it has an 83% probability of success, but this reward doesn't excite me enough. Okay. Yeah, so Myron, I was having a little issue here because I accidentally clicked my advanced order and changed it to a first trigger sequential, and I really needed it back to a blast all. Okay, so this is the initial order we looked at. Now we're dropping down a couple strike prices and putting together a different spread here, where our max theoretical gain is $35. So on this, our risk is pretty low, but our reward is kind of low as well. Okay. Now the key here is where where your probability is and how comfortable you are with that. Because typically when we're putting on a trade, we want to see 60+%. Or pretty dang close. Maybe it's 59.7 or something, okay? But something's giving you an idea that, yeah, there's more likelihood that it's going to work out for you than it's not. Now, here's the other extreme here is somebody that says, I actually would rather bring in a bigger reward because if I lose on that, I actually lose less. Okay, so we're going to go the other extreme here. We're going to come up here. Let's see how high I did in what I was thinking we might do here. Okay, we're going to go here with the 245. That's a 40 delta. Okay, so what is that? That's the edge of our 30 to 40 delta range. Same thing here. We're just going to do sell vertical. And here's our reward, 95 cents. Okay, so we'll put 95 is our max gain here. Our max loss in this case should be what? That should be $1.55, right? And let's grab that calculator again here. And let's kind of see what reward we get out of that. So 250 or 0.95, our credit divided by, that should be 1, I better do math here. 0.95 minus 2.5. I'm gonna make sure I'm not messing this up. And I forgot to stick a little decimal in there, 55. Okay, so 155 is gonna be what? A bigger percentage. It should be a bigger percent because we're risking less. So that comes out about 61%. Okay, so if we're wrong, we lose, our max loss here is about 155 versus getting a gain here of 95. So this person's kind of going, hey, I would like to lose less and gain more if the trade goes my way. But where's the probability of this 40? It's a 62%, so it actually starts in a range. Now, you guys are helping me out with something. I think I did a typo on this middle order here. So let's just redo that real quick here. Okay, this is our 35 cents minus 2.5. And I had put it at 165. It's really 215. So that's where I was off 50 cents. Okay, thank you for helping me out with that. Let's redo the calculation. Okay, it's really not going to be 21%. It's going to be 0.35 divided by 215. And let's do that. Divided by 215. There we go. 16%. You're right. Sharon, you said, yeah, about 16.3%. Yeah. So let's change that. Let's make this right. Okay, so we have kind of some extreme points here. And they each could be comfortable to different types of people, depending on if you want what you favor more. Do you favor more reward? Then you're going to have to tolerate more risk. If you favor probability, then the settlement is a lower reward. And you're just trying to find that balance. Now, I'm going to call this one A. We're going to call this one B. We're going to call this one C. And there's not a right or wrong answer here. I want to know which one you personally are more comfortable with. Okay. Just kind of to get a poll to see kind of where the class might be coming in here. Go ahead and chat that in. All right. Now, Kelly, you said, and I don't know when you sent this in, Kelly, that said I'm generally in that area. If you were saying that for the 61% return, the 31% return, or the 16. So A, B, or C. Again, there's not a right or wrong. is simply where your comfort level is. Okay, we've got a Kelly's a C, Tommy's an A, Ray's an A, Sharon's an A, Chris is an A, Adolfo's an A. B, we've got John likes B, so a little bit further out, right? Lower risk, lower reward. That's your comfort zone. We've got a couple of you there, John, Mr. Jones, Myron. Okay, so yeah, we're going to have a little bit different tolerance that we feel comfortable that we can sleep at night. Now, none of you jumped on this C. None of you felt that way, and that's fine. It's just that some people could have a different perspective than what you perceive for yourself is more comfortable. Okay. So if this were your question, if you're the one that said that here, I hope having this discussion and showing you different ways we could construct the trade gives you a little bit better feel for, okay, you know, what do I feel best about? Okay. And think of it in terms of what if you had 3 bad trades in a row? I mean, I don't wish that upon you, but it could happen, right? Markets can sometimes change based on whatever big news item came out that we weren't expecting, right? And so you've got to be able to sleep at night. And if somebody said, you know, I am not going to sleep good at night here, knowing that even though I have a 95-cent credit, I'm risking $1.55 for it. Some people might just say, I'm not, that reward of 61% is not worth it to me. Okay. And there are a few of you that do feel comfortable. Tommy's there, Will's there. That's okay. Yeah, everybody's going to be a little bit different. Now, normally I do not do all of these scenarios, right? We'll talk about and discuss kind of the difference sometimes. But I'm going to put the one in that the class was more comfortable with. Now, John says maybe you need to study the chart a little bit more. Go back there, John. Okay, let me actually give us a little room. So one of our strike prices was at 250. I think one of them was at 245, and I think the other one might have been up here. Let's see what that most conservative one was at. That was at 255. So 250, 255, 245. So they're $5 increments spread out. Okay, so yeah, all of them give you some cushion. You know, it's just where are you most comfortable? The 245 is the one that had the least amount of cushion, is about right there. But it looks like right now, at least the way the market's going, that it's going to give us that trade below the low of the high day. All right, we're going to zap A. No, actually, A's the one everybody liked more, right? So we're going to zap C. Goodbye, C. And I'm just going back and seeing if I'm canceling the right one for where most of the votes came in. I think there were a few more votes on A, but there were a few on B, going a little bit further out of the money. So we're going to keep the 60-cent credit. We're going to delete this one, and this is the one we're going to use. This one will position size 2. We will let ourselves risk $1,500 in any trade. And so in this case, if we have a max theoretical loss of 190, how many contracts can we do? Okay, we'll do our 1,500 divided by 190. Too fast to fingers. We can do 7 contracts. So we're going to do it. The next thing that came in here, actually, this is a question from one of you that responded to put a question out in the comments section on YouTube. And the question was, I got put some stock. What should have I done different? Okay, we're going to look at a short put vertical in a minute, and we're going to kind of entertain that question. All right, we're going to change this to a first trigger sequential because we're ready to really cue it up. We're going to put in the opposite order. When we get a chunk of 60 cents, we're going to just buy this thing back. We're not going to go to options expiration. So if we get, let's say, 70%, we've got 30% left. We'll go buy it back at 18 cents here. We'll let Thinkorswim do it for us. We'll have our order sitting out there that we know we would be thrilled and tickled pink if it did that, and would kind of like capture the gain, move on to a new trade. All right, that's our intent here. So we are going to put this in this one was a bearish one. It was IBM, so we're going to send that one over there. All right. Somebody had said something that depends on the percent or where we are in the month. And so that's one other thing that some people will consider. They'll say, if I have 29 days left, I want to at least get, say, I have 1% return for every day remaining. And in that case, it would be 29% that a trader could target for. Okay. All right. Lakshmi says, I remember a few coaches taught us that a 1 to 3 ROR possible trades a while ago. For that scenario that most of you are comfortable with, which was scenario A at 31%, that's kind of pretty close to how it worked out. If it would have been your third, then it would have been 33%. It was just a skosh lower than that. Yeah, very good. The other question I wanted to answer from our survey is something that I'm just going to touch on, but we are not going to trade anything based on it. Okay. And I'm going to head here to a tab I'm going to bring over to you. Shazam. This is our Trader Talks channel on YouTube. And somebody said, could we talk about leaps? Well, in this class of short verticals, leaps is not even going to be a consideration. Leaps are contracts that have at least 7 months left before they expire, but they're created way in advance. They could be 2.5 years ago that they were created. They could be 3 years ago when they were created, 3.5 years, going way out. Most of them are like 1.5, 2.5. And so with a short vertical, we're balancing wanting time decay to work in our favor. And so going out that far really is not something we would entertain. But because you're interested in that, let's come over here. Suppose you're a subscriber. You can go down and click on that subscriber if you're not there yet. And then you could say, I am interested in leaps, or whatever the concept is. Okay, the thing that came in for us was leaps. You can type that in, and then you're going to see some different classes that have been done on leaps. So here's one Ben did in February, one that, let's see, it looks like Brent did in January. Brent did another one out here in May. So that one's actually a little bit more recent. Mine was quite a while ago. Mine was back in December of 24 when we did a class on leaps. And so if there's something you're interested in, feel free to use this search and identify a webcast that's going to talk about it. But we won't be able to do it in our class because it's kind of off the radar. Okay, but I did want to answer that question. All right. Yuri, we can take a look at that. In fact, we'll do that real quick. Yuri's wondering about another short call vertical that we did. I think it was in Monday's class, Barb Armstrong's class. We did trading a smaller account. And I'll just bring it up here real quickly. All right. The trade I'll show you here was in our trading a smaller account. And it was this trade right here, VKTX, Viking Therapeutics. This was a short put vertical. We were bullish on it. It had really high volatility and it had a really high beta. Let's go there real quick. VKTX. And the beta can be found to expand that little caret, click it so it faces down, and then you can see the field over here. Got the right one in there. This beta has changed remarkably from when we looked at it in class. When we were looking at it in class, it said it had I thought it was like a 5.3 beta, which is volatility, about 5 times more than what the S&P average would be. And as we were looking at the contracts, we were seeing a lot of implied volatility priced in him. And these are down from what they were. What I neglected to do, what the big faux pas was in that case, and so it's a good lesson to bring up, is I was seeing really high volatility and I should have checked into why there was high volatility. We knew earnings were back here, and so that was not even a question. Okay. But they had a little drug that was waiting for some information to come in about the efficacy of this new, I think it was going to be a weight loss pill. And it came back that it didn't work so good. Okay. Going into that, that's what was going on. We had these super high numbers. So I'm going to add a little step in there. If you see something that looks like extra large, something that looks super volatile, pharmaceutical type stocks and bioscience type stocks sometimes can be quite volatile. Look into the news and see what's going on to see why it's so high. I neglected to do that. And so right now that trade is sitting pretty much at a decent loss. We brought in 99 cents on a let's see, $2.50 wide spread. So it's sitting here pretty close to our max theoretical loss on it, right? So there's probably not a lot we can do except maybe wait, go through 29 days, see if we find a better exit point that we can get out losing less, okay, on that particular one. All right, let's look at another trade here. We're not going to go into this much detail on it, but I do want to cover another trade with you here real quick. Let's do this one. Let's take a look at the chart, see if it's still looking good. Newmont Mining Company, I guess it's just Newmont Corp these days. This one has been in a nice uptrend. It pulls back sometimes to the 30. We can see that. Looks like it came down to the 50 back here in early June. We had a different trade. I don't know if it was in this class or another class. It could have been this class because this came off of our watch list. And kind of what are we seeing through here right now? I would say we're seeing maybe something that looks like, well, that's black. Black is not going to show up good. Let's go with yellow. All right, maybe something like a flagpole and a flag consolidation area, and looking like it's breaking out of the flag today. Obviously, we're not at the close, and it's not guaranteed to close there, but right now it's looking like a breakout. So we're going to treat it as a breakout and do a short put vertical on this. Okay, that's the setup. We might expect the stock to run about as high as this flagpole was once it breaks out. We're not necessarily going to use that as a target for our short vertical, but just know that that could be something some people might do. Okay, maybe more like a swing trade in that scenario. Okay. Oh, Greg. Greg's saying Brent's video was "Do leaps belong in your portfolio?" That must mean maybe you listened to that. That's excellent. Yeah. All right. What are we looking at here? We're going to go with the September options again. We're not going to we're not going to do every possibility, but by now you might have an idea. Okay, we have a 40 delta, a 34 delta, a 31 delta, a 28 delta. All of these could be considerations. We're going to go with the middle of the road. I'm going to go here with lots of open interest. We're going to sell the 67.50, and then we're going to come out to the 65. We're not going to do these smaller increments where there's not a lot of open interest. So let's go ahead. Let's do our sell vertical. Swap this out to 65. And we've got a $2.50 wide spread, something we're kind of familiar with. Our other trade was that as well, wasn't it? Okay. We've got a 67-cent credit. Let's run the numbers on it. So we've got 0.67, and we'll take minus 2.5. It's going to give us our max theoretical loss, 183, I think that said. Put max gain, 183 as the max theoretical loss. Okay, so again, how big is the reward compared to the risk? Let's go run that number here. All right, 0.67 divided by 1.83 gives us about a 36% return. Now, we were talking about, is that at least 1% for every day that's left before it expires? In this case, yes. Okay. We need our calculator back here again, because if we are willing to risk 183 and we can risk $1,500 in any trade, let's see how many contracts we could do here. we can do 8 contracts. So that's exactly what we're going to do. Get our 8 here. Let's do our first trigger sequential. We're going to set it up to take a profit, exit on it, create an opposite order. When we get a chunk of 67, this time, let's go with, say, what if we can get a decent amount of that sort of soon? What if we got 67 divided, let's see, 67 times, let's just go 70% again, okay? Only 30% would be left. We'd go buy it back for 20 cents there, okay? Now, you don't have to set your orders up this way, but it can be helpful if you know an area where you might be satisfied and say, yep, I like to just have the stock move the way I think it's going to move, if it does, and collect that profit and not try to bleed every little last penny out of it. All right, and this one we're going to put in our bull short verticals bucket. All right, we're going to watch that. Oh, good, we got filled on it. Nice. Myron says on that 183 max loss, where does that come from? Let me bring the calculator up here again and clear that out. We took $2.50 was the spread on the strike prices of the trade. And so we said, all right, our credit that we were going to get was 67 cents. And so we just did, we really were going to take 2.5 minus that credit. And that's going to give us $1.83. So this is what we would be risking on the trade in order to gain 67 cents on the trade. Okay, that makes sense? Let's see here. If you have a question about that, that's a great question to ask at that time, Myron. I appreciate you doing that. Somebody else might have the same question. Let's do one other thing here, and that is I just want to give you a short update on a couple of our trades. CRM is bearish, and we're down on it a little bit right now, but it's got 29 days before it closes. Okay, so we've got time on our side. We're going to collapse that. Disney, we've only got 8 days left in Disney, and it's a short call vertical, 117, 115. We brought in a credit of 62 cents. Now it's gone against us. That spread is now worth $1.12. I want you to go to the chart with me and decide, could the trade still work out? We're in our window 10 to 4 days before the option expires. Would really like to get out of the trade there. Here's our line where our short strike is at 115. You know, I look at that and I go, well, I'm not convinced we're wrong. I think possibly it could continue to show some weakness. Was going down today. Maybe what we'll do on this one is try to find an exit point that's a little bit more feasible. Okay, maybe we have to have a small gain or a small loss on this trade, but because it's so close and can go that direction, I'm going to wait it out a little bit longer, but we're going to look at it every day. We might even look at it twice a day just to see where it is, to see if we can find a little bit better exit point than where it is right now. Okay, so yeah, we are upside down on the trade a little bit. Still could possibly work out. We got on here on that day. All right. Well, you guys, my time is up. We covered a little bit of ground here today, and I hope that, you know, my big thing was wanting you to feel more comfortable about when selecting strike prices, where your comfort level is. Where do you feel like you can, you know, sleep at night if you lose 3 trades in a row? Are you more comfortable with scenario A, B, or C? Most of you are more comfortable at kind of the middle between that, the 30% range, which is just fine. Okay. All right. Now, I did not see a survey out here. If there was a survey, Barb will post it here again, and it's probably pinned to the top, but I did not see one come through. But if this was helpful to you today, go ahead and hit the like button on the way out. Make sure you're following Barb and I on X, Barb and me on X, Connie Hill CS, Barb Armstrong CS, and would love to have you be a subscriber so you can find our content. So don't forget to do that. All right, everybody, coming up next, we're going to have a little break in our programming right at the top of the hour. We're going to have Mike Fairborn. He's going to be doing scripting studies, and he's been putting together some really cool content for that class. So if you can stick around for it, he'd love to see you there. I'll see you tomorrow in advanced options. Otherwise, have a great afternoon, everybody. Barb, thanks for your help out in the chat. Bye-bye.